Something interesting is happening with how Australians are investing in 2026, mate. If you've already got $100 sitting in an ETF, or you've been telling yourself, yeah, I'll start investing next month, for the last couple of years, this might be the video that finally gets you moving. Because this isn't just about ETFs becoming more popular. It's about the way everyday Aussies are starting to think differently about building wealth over the long term. And once you see the numbers behind it, you might find yourself wanting to have a proper look at your own finances before the day's over. See, money trends in Australia usually don't arrive with fireworks. They sort of sneak up on you. One minute hardly anyone's talking about investing, and the next you're at a barbecue and someone who reckons they doesn't really know much about shares is casually telling you about their ETF portfolio. And this time, the numbers genuinely back it up. According to BetaShares' latest industry review, the Australian ETF market finished last year with a record $330.6 billion under management, growing by 34.2% in just 12 months. Investors added a record $53 billion during the year, which was 76% more than the year before. They're also expecting the market to pass $400 billion sometime during 2026. That's not some tiny investing niche anymore, mate. That's a pretty clear sign that more everyday Australians are choosing ETFs as part of their long-term financial plan. A big reason for that is probably something we've all felt over the last few years. The cost of living has gone up, household budgets have become tighter, and people are paying a lot more attention to where every dollar goes. Naturally, that means more people are looking at investment fees and asking whether they're actually getting value for money. At the same time, investing has become easier than ever. Low-cost brokerage apps have taken away a lot of the barriers that used to put people off. Put those two things together, people becoming more conscious about costs and investing becoming incredibly easy, and it's not hard to understand why ETFs have become so popular. For a long time, ETFs were mainly something experienced investors talked about. These days, though, they're often the first investment people look at when they're starting out. And it's easy to understand why. They're simple, they're diversified, and they usually cost a lot less than many other investment options. For plenty of new investors, they're become the easiest way to get started without feeling like they have to pick the next winning company. So in this video, I just want to break down what's actually driving all this growth, explain what an ETF really is if you're completely new to investing, and have a chat about why getting started often matters more than trying to perfectly time the market. By the end, you'll have a much clearer idea whether ETFs are something worth looking into right now, or whether sticking with your current plan still makes sense for you. Quick disclaimer before we jump in, mate. I'm not a financial advisor, and this definitely isn't personal financial advice. Everyone's situation is different, so treat this video as a starting point for your own research rather than the final answer. Now, if you've never heard of an ETF before, here's probably the easiest way to think about it. Imagine walking into the supermarket. Instead of buying just one apple, you're buying the whole fruit basket. ETF simply stands for Exchange Traded Fund. Rather than putting all your money into one company and hoping it performs well, you're buying tiny pieces of dozens, sometimes even hundreds of different companies all in a single investment. A lot of Australians start by looking at broad market ETFs, maybe something tracking the ASX 200 for Australian companies, or a global index fund for international exposure, before deciding what suits their own goals. The attraction is pretty straightforward: instant diversification, generally lower fees than actively managed funds, and you can buy or sell them just like ordinary shares. Something else that's happened recently is that more Australians have started paying closer attention to their super. A lot of that comes from discussions around proposed tax changes for people with very large super balances. Now, those changes won't affect most Australians directly, but they have encouraged plenty of people to actually log into their super accounts and have a proper look at where their money is invested. And once they do that, many realize their default investment option might have different fees, different levels of risk, and different long-term performance compared to other options inside the same fund. That's worth checking because it varies from one fund to another. Super is still one of the most tax-effective ways Australians can invest for retirement, but once people become more interested in understanding their super, it's pretty common for them to start looking at investing outside super as well. And that's usually where ETFs enter the conversation. The other thing that's made a huge difference is accessibility. Buying ETFs in Australia is now cheaper and easier than it's ever been. Brokerage fees that used to cost around $10 a trade have dropped close to zero on several platforms, and some now even let you invest from as little as $1 using fractional investing. That means getting started isn't nearly as intimidating as it used to be, especially if you're just beginning. Now here's the part: a lot of people underestimate timing, not because you need to find the perfect day to invest, but because waiting quietly costs more than most people realize. Imagine two mates both decide they're going to invest $100 every week into exactly the same ETF. One starts today while the other keeps saying, "I'll get around to it," and waits another 2 years. After that, they both invest the same amount and earn the same average return. The only difference is that one got started earlier. Those first 2 years don't just mean extra contributions. They also mean 2 extra years of compounding, where your investment starts earning returns on previous returns. Over a long period of time, that gap can become surprisingly large. That's why people often talk about dollar cost averaging. Rather than trying to predict the perfect time to invest, you simply invest consistently over time and let the long-term averages do the heavy lifting. Now, none of this means ETFs are risk-free, because they're definitely not. Like any investment connected to the share market, their value goes up and down, and sometimes those drops can be pretty sharp when markets get volatile. That's completely normal. Short-term declines don't automatically mean something has gone wrong. It's simply part of investing. That's also why ETFs are generally viewed as long-term investments rather than something you judge after just a few months. If anyone tells you they're a guaranteed path to wealth, they're leaving out a very important part of the story. So when you put everything together, it's easy to see why ETFs have become such a big part of the conversation. More than $330 billion is now invested in Australian ETFs. Last year saw record inflows. Investing has become easier than ever. Fees have come down, and more Australians are taking an active interest in their finances than they were just a few years ago. Different reasons, same outcome. More everyday Aussies are learning about long-term investing and taking those first steps towards building wealth. At the end of the day, mate, markets don't reward people for finding the perfect day to invest. More often than not, consistency beats perfect timing. If you've got a mate who's been saying, yeah, I'll start investing one day, send this video their way. And I'd love to know where you're at as well. Have you already started investing this year, or are you still sitting on the sidelines waiting for the right time? Let me know down in the comments. Keen to see where everyone is on their investing journey.